going to be talking about the recent speech given by Michelle Bowman. Now, I'm not reviewing the entire speech. I'm just going to go over a small section within it, but it is incredibly revealing. This is talking about the true monetary policy coming from the Federal Reserve. Many times I have been asked what is going to happen with interest rates. When the interest rates cuts, what's going to take place within the economy? People have many videos out there. There's lots of economists talking about the interest rate cuts and what that would mean to the economy, but very few people incorporate or take in the idea that that cut or that interest rate adjustment is delivered with a message, and that message that is delivered is the real monetary policy. It's not the interest rate adjustment that takes 6 months to a year to really impact the economy, but the message that is delivered with that interest rate adjustment is incorporated immediately by the markets. Now, this is something that I've been trying to share with the audience for years now, the credible threat theory, and that the Federal Reserve is guiding the markets using their words, using the expectations of what it is that they plan on doing into the future, and they're guiding that. Right? They're guiding that expectations. Now, I've left a few links down in the description for you guys, and they're links that I have gone over before, mainly talking about Jefferson's speech given back in May 13th of 2024. This was really an excellent speech communicating about monetary policy. And the reason why I want to bring this up is because of this particular topic right here. It says expectations become a focal point in academic and policy circles with the emergence of the new Keynesian models in 1990s as a framework for monetary policies. It goes on to say this: in these models, aligning, the expectations of decision makers. We're the decision maker. What we do with our investments, what we do with the debt issuance, what we do with our business plans, everything that we are doing, we are the decision makers, right? In the private sector, that's us, with those of the policymakers. The policymaker is the Federal Reserve, the FOMC. They're the ones who conduct monetary policy. We are the decision makers in the market. So let me read that again. In these models, aligning the expectations of the decision makers in the private sector with those of the policymakers produce superior economic outcomes. Goes on to say, Mike Woodford, one of the developers of the new Keynesian model, put it this way: not only do expectations about policy matter, but very little else matters. See, now this is the problem that most people end up facing, is that they look at the Federal Reserve in a way that would have been accurate or realistic, say 20 years ago, when they would conduct monetary policy in a somewhat of a secrecy. In fact, he talks about it right here. In 1981, Karl Brunner, the Swiss monetary economist, called central banking an esoteric art and lamented central banks' quote, inherent impossibility to articulate its insights in explicit and intelligible words and sentences, end quote. He goes on, Jefferson goes on in the speech to say, at the time, central banking wisdom dictated that monetary policymakers should say as little as possible. Some research of that vintage tried to rationalize this secrecy through the notion that monetary policy would be particularly effective if it surprised the markets. So now, back in the day, the Federal Reserve would try to surprise the markets with an interest rate adjustments. They thought that they could get more power out of it if they could surprise the markets. But then they later found out that if they communicated about the monetary policy, they could get more power out of it. And that's where that decision was made to not, what was it, that, how did he put it? Mike Woodford put, not only do expectations about policy matter, but very little else matters. So it became the new model was to guide markets, guide the expectations. Basically they developed this idea called forward guidance. But then forward guidance is something that they are actually declaring. Hey, we are telling the people we're cutting at the next meeting. We may not know by how much, but we are definitely doing that. And they put that forward guidance into the market. Now what they have is a message, a signaling that takes place. Now, this is where the critical information gets in here, right? Because I've repeated this stuff many times on my channel up until this point. Michelle Bowman's speech, get this, guys, right? Let me bring this speech up. This is incredible. You guys are going to love this, right? In her recent speech given September 23rd, 2025, so we're talking like 3 days ago, right? This is what she has to say, and I'm going to read this section of the speech, and then we'll go back and we'll review it because this is so good, guys. I mean, this is literally like confirming the credible threat theory right here. Everybody else who is talking about the interest rate adjustments and the impact from the interest rate adjustments, they're missing it. They are so missing it because that's not what the Federal Reserve is trying to do. They're trying to guide expectations, and it's working. Listen to what Michelle Bowman says here, and then I'll go back and I'll break it down for you guys. So I'm going to read it. This section of the speech. This is on page 7 of the speech. I left a link down in the description for you guys. In light of all these considerations, in my view, it was appropriate to begin the process of moving policy toward a more neutral stance at this meeting, and it has been for several months. In thinking about the path forward, I supported revising the characterization of the policy outlook in the post-meeting statement. It is important we signal that last week's action included a forward-looking view of additional adjustments. If the statement had not included a reference to the additional cuts, it would have signaled to the markets that the committee would not be responsive to weakening labor market conditions. I am concerned that the labor market could enter a precarious phase, and there is a risk that a shock could tip into a sudden and significant deterioration. Characterizing an appropriate forward-looking view of additional policy adjustments is important because it shapes the expected path of the short-term interest rates, which, in turn, affects long-term interest rates, including mortgages and corporate bond rates, that are key for households and business decision-making. Cutting the policy rate 25 basis points and signaling additional rate adjustments at the upcoming meetings should allow long-term interest rates to remain materially lower than earlier this year and help to support the economy. Now, I know that was really complicated, and the first time you hear it, it's kind of overwhelming and it just kind of flies past you. That's okay. We're going to break this down. Now, before I break it down, I want to go back to Jefferson's speech one real quick, not the one that we just referred to, but a different one. This was given February 21st of 2025. It's called Textual Analysis of Central Bank Communications, reading between the lines. Now, the reason why I bring this speech up is because this is what Jefferson had to say in this speech. Using textual analysis, high-frequency asset price data, and high-frequency central bank communication data, this research shows that investors' reactions to specific sentences communicated by the central bank are quickly incorporated into asset prices. So here, Jefferson is saying that the central banker's communication, when they go out there and they start speaking, that is quickly incorporated into asset prices. There are specific sentences that the central bank can use. Again, reactions to specific sentences communicated by the central bank are quickly incorporated into asset prices. He goes on to say, policymakers, right, that's the Federal Reserve, know that their communications are likely to affect the course of short-term interest rates, other asset prices, and the associated economic outlook, resulting in an easing or tightening of financial conditions. Again, it's their communications that are doing it. Communications are likely to affect the course of short-term interest rates, other asset prices, and the associated economic outlook, resulting in an easing or tightening of financial conditions. So again, here we have Jefferson telling us that the central bank, this is months ago, that the central bank knows that there are specific words and sentences that they can use that will be quickly incorporated into asset prices. And they know that their communications will have an effect that will either be easing or tightening of financial conditions. Remember, this is all their communication doing this. Not any actions, communications. They know it. They're sharing that with us. Nobody seems to recognize it, not out there in the mainstream media, not out there amongst all the other economists out there. We recognize it because we keep following the credible threat theory, and we see this. We see it firsthand when we see these speeches like this. Okay, let's go back to Michelle Bowman's speech real quick and break this down again, this section of this speech. Again, this was given September 23rd of 2025, so it was just the other day. So let's break this speech down one more time, just in this section of it. It says, in light of these considerations, in my view, it was appropriate to begin the process of moving policy toward a more neutral stance at this meeting, and it has been for several months. Now, this is not new to a lot of people who have been following the Federal Reserve and believing that the Federal Reserve is attempting to get to neutral. The neutral interest rate may have been rising off of the credible threat of tariffs and elevated inflation expectations, and the Federal Reserve moving their Fed funds rate down gets ever closer to the neutral rate. This is what they are attempting to achieve. Get the Feds to neutral, or if neutral happens to rise, to the Fed funds rate. Goal is accomplished. But that's what the Federal Reserve is up to. Get the Fed funds rate to neutral, or if neutral finds the Fed funds rate, goal accomplished. All right. Goes on to say, in thinking about the forward path, I supported revising the characterization. This is interesting. Revising the characterization of the policy outlook in the post-meeting statement. Like, a lot of people might just hear that and just throw it off and say, that wasn't no big deal. It's just, words. It's not. Revising the characterization of the policy outlook in the post-meeting statement. There was a post-meeting statement. How many times have I said it? They're going to adjust interest rates and deliver it with the message. That is the post-meeting statement. That is the message that they are delivering with that interest rate adjustment. She is talking about revising the characterization of it, right? To be able to use that communication in a different form, or at least revise the communication to deliver a message. So important, right? And goes on to say this. It is important we signal. It's important. The Federal Reserve must signal, send out a signal, a communication signal, right? It is important that we signal, it is important we signal that last week's action includes forward-looking view of additional adjustments. It was important that they signal this, that there would be a forward-looking view of additional adjustments. They had to communicate that. That was part of the plan. That was part of the communication with the interest rate adjustments, was to deliver that message, right? It was important we signal that last week's actions includes a forward-looking view of additional adjustments. That must be internalized. If the statement had not included a reference to additional cuts, if they did not include that message with the interest rate adjustments, if they did not communicate that, it would have signaled to the markets that the committee would not be responsive to a weakening labor market conditions. See how they adjusted the expectations of the markets by a delivery of the message? See, the interest rate adjustment was the same. If they did not deliver that message, they would have spooked the markets. They knew it. They had to deliver specific words and sentences in order to get the reaction out of the markets they were looking for. This is so important. Like, this is the most important monetary policy understanding that you could take in right now. All those people who are looking at interest rate adjustments and talking about how much they need to cut interest rates and stuff like that, they are so missing it. We are literally the only ones discussing this right now on YouTube. It goes on to say, I am concerned that the labor market could enter into a precarious phase, and there is risk that a shock could tip it into a sudden and significant deterioration. Remember, this is the message, characterizing an appropriate forward-looking view of additional policy adjustments is important. The promise to do it in the future. Characterizing an appropriate forward-looking view of additional policy adjustments is important. They have to deliver that message with this. It was important, right? Because it shapes the expected path of short-term interest rates, which in turn affects long-term interest rates, including mortgages and corporate bond rates that are a key for households and business decision making. Do you see how they did that? This is so important. This is so critical to understanding monetary policy. So many people are missing this. They do not understand how it is that the Federal Reserve is using specific words and sentences to guide expectations. Michelle Bowman is straight up admitting it. Straight up admitting it right here in these 2 paragraphs inside of a speech that she had given. She breaks it down and says it straight up, right? Characterizing an appropriate forward-looking view of additional policy adjustments is important because it shapes the expected path of short-term interest rates, which in turn affects long-term interest rates, including mortgages and corporate bonds that are key for households and business decision-making. Listen for the message. The message is the important part. It's not the adjustment of interest rates, which is important 6 months to a year down the road. The immediate impact from the communication is by far the most impactful thing for you to make a decision on today. The communication of it. Goes on to say, cutting the policy rate 25 basis points and signaling additional adjustments at upcoming meetings should allow long-term interest rates to remain materially lower than earlier this year and help support the economy. It's all about the signaling, right? Signaling additional adjustments at upcoming meetings should allow long-term interest rates to remain materially lower than earlier this year and help to support the economy. This is how they're conducting monetary policy. It's through communications. It's through the statements. It's through the characterization of an appropriate forward-looking view. All right, see how they use these words? Most people, when they heard that first time I read that, it went right past them. When I break it down, it all of a sudden starts to make a lot more sense. Let's read it one more time. What time is it? 17 minutes into this video. Let me read it one more time because now it's all clear, right? We've cleared up the jargon. It says, in light of these conditions, in my view, it was appropriate to begin the process of moving policy toward a more neutral stance at this meeting, and it has been for several months. In thinking about the path forward, I supported revising the characterization of the policy outlook in the post-meeting statement. It is important we signal that last week's action includes a forward-looking view of additional adjustments. If the statement had not included a reference to additional cuts, it would have signaled to the markets that the committee would not be responsive to a weakening labor market conditions. Remember, all about expectations. I am concerned that the labor market could enter a precarious phase, and there is a risk that a shock could tip into a sudden and significant deterioration. Characterizing an appropriate forward-looking view of additional policy adjustments is important because it shapes the expected path of short-term interest rates, which in turn affects long-term interest rates, including mortgage and corporate bond rates that are key for household and business decision making. Cutting the policy rate 25 basis points and signaling additional adjustments at upcoming meetings should allow long-term interest rates to remain materially lower than earlier this year and help support the economy. Isn't that incredible? Right? See, it's all about the message being delivered. I don't know how many times I have said that over the last few years, that their actions are not nearly as important as the communication and the statement that is delivered with it. Michelle Bowman is breaking that down for us. I mean, straight up says it. If the statement had not included a reference to an additional cut, if they did not throw that out there saying, hey, we got more cuts coming into the future, then it would have signaled to signaled to the markets that the committee would not be responsive to a weakening labor market. Now that they've put that forward guidance out there, they put that credible threat, the markets are very well conditioned to believe that the Federal Reserve will respond to the labor market. Okay? This is how monetary policy is going down. Most people will miss it. They're going to talk about how it is that the Federal Reserve is moving because of political actions or, something else that's going on out there. But yet here, the voting members of the FOMC, Michelle Bowman, straight up saying, hey, we are conducting monetary policy with words, with expectations, with forward guidance, right? Characterization of the policy outlook. 151 people watching right now with 28 likes. Thank you so much for hitting that like button. I hope this information is helpful and useful to you, because this is something else that I found. Now that I've gone through that, this is really interesting piece of oops, where'd it go? What's going on? How come I can't? My screen all of a sudden just went black and I can't get my... There we go. Okay. Oh, it's still not doing it. Bummer. Oh, I was going to share this file that I have found earlier, but now I can't seem to bring up these pages. Huh. My computer is just like, anytime I ever want to use my computer for making a video, it just craps out on me and never works right. Nope, it just won't bring up. Okay. Well, it was called The Secrets of the Temple, or Secrets from the Temple. And this is a really good working paper that I believe came from around 2008, given by John Williams, right, the New York Fed president. And it really is talking about how it is that they are using expectations to guide markets. But man, if I cannot bring this thing up, then how am I supposed to? Bummer. Oh well. But I can't read from it if I can't bring it up, so... Oh, that one comes up. Let's try it again. All the rest of the files come up though, huh? Okay, that figures. Well, thank you guys for hanging out while I try to figure this thing out, but I'll see if I can find a link to it if I didn't already link it into this video. Secrets of the Temple by John Williams. And man, what a great piece of work that it talks about how it is that they're using expectations and forward guidance. And this is really in the early days of the idea of using forward guidance. See, when the Federal Reserve had the Fed funds rate hit the lower bound of zero, they essentially lost monetary policy at that point. And with no ability to adjust interest rates to actually stimulate the economy, they had to come up with a whole different concept of what it is that they were going to be doing in order to stimulate the economy, which essentially meant that they would have to put out there a belief system within the markets that they would stick to this low interest rate environment for the foreseeable future, like extra low, extra long for an extended period of time, zero interest rate policy. At the exact same time, they fired up quantitative easing and started buying a ton of mortgage-backed securities and mainly treasuries from the government. Well, it was buying it from the public, but essentially buying a bunch of government bonds. Now, with this excessive money printing and the promise to keep interest rates at the lower bound of zero, what they were essentially able to do is create an inflationary expectation within the markets that then created the monetary policy that they would look for, which was elevated inflation, right? because they were actually risking inflation being too low. And I know that's a weird concept for a lot of people to try and internalize, but that was the problem after the great financial crisis, is that the Fed was at zero and inflation was running consistently, persistently under 2% target. And they could not get that inflation up above the 2%. Even after all the quantitative easing and the promise of zero interest rate policy, it still wasn't enough, right? Let me see. Let me try this. Maybe I can find it this way. No, it just does not want to bring that up at all. Okay, well. And so, anyway, since they couldn't use monetary policy to actually adjust, or use interest rates to adjust monetary policy, they started putting out that forward guidance. Hey, we promise we're going to keep interest rates extra low, extra long for an extended period of time, plus all this quantitative easing. And the people's expectations was hyperinflation. I know, I was one of them, right? I dumped all my money into silver during a time in which I really couldn't afford to do that. I ended up, losing my job, losing all kinds of stuff. I went through all this hell thinking that the monetary policy or the dollar and all that was going to fail. Like we were going to run into a hyperinflation scenario and my silver was going to save me. That's what I had believed at the time. Now, inflation never came. All right. We had a little bit of inflation, asset price inflation, real estate inflation, stuff like that, but we didn't have the inflation that the Federal Reserve was looking for in order to conduct their monetary policy. That was incredibly subdued. Right? So that was the major problem that they needed to fix, was how do we create an inflationary expectation that is well elevated? And by elevating that inflation expectation, they were able to start raising the Fed funds rate and in turn started pulling the neutral interest rate higher. See, that was the major problem that they faced, is that neutral interest rate was also close to zero. So when the Fed hit zero, no more a downward adjustment can be made, and they weren't very far below neutral to actually create any kind of stimulating effect. But with all the money printer and the buying of assets and then the expectations out there, they were able to regain some of their monetary effectiveness, even though we couldn't stimulate the economy with the lowering of interest rates. So that was like kind of a key to understanding why the Federal Reserve was then moving into a position in which that they absolutely were desperate for inflation. And that was after 2018. I mean, if you go and you look at like monetary policy strategies for a low neutral interest rate world, that's another speech given by John Williams. So good. I mean, it's excellent. He breaks down pretty much in the entirety of the reasons why it is that the neutral interest rate had fallen and how that was interfering with monetary policy and how the Federal Reserve would need an elevated inflation and inflation expectation to solve their monetary policy. And that was given in 2018, before COVID, like way before COVID. And then even as COVID was kicking in, there was a strategy called the makeup strategy, where they would let inflation run extra hot, extra long for an extended period of time. It says here, the makeup strategy works best when the public understands, believes, and reacts to policymakers' commitment to offset misses in inflation from the 2% objective in the future. In particular, makeup strategies are most powerful when policymakers can influence the public's inflation expectations. Right? Doesn't like the reality doesn't necessarily need to be what you expect. Your expectations are far more important. Right? In doing so, policymakers face a dynamic tension. They must maintain long-run inflation expectations at 2%, at the 2% objective, while at the same time moving short-run inflation expectations in response to the new strategy. Ultimately, they were going to let inflation run extra hot, extra long for an extended period of time to make up for the fact that they failed to achieve the 2% target. When they developed the tools to do that, knowing that interest rate adjustments weren't going to work, that tool was the communication. That communication is by far the most important thing to the Federal Reserve when it comes to conducting monetary policy, and we learned that from Michelle Bowman's speech earlier, right? Just given just a couple of days ago. I'm sorry I can't bring this other thing up, man. That would be so good if I could. Let me see. Maybe if they... Let me try it like this. Hold on one second. It just doesn't want to come up. Bummer. Yeah. Ah, got it. Okay. Revealing the secrets of the temple. All right. The introduction to this. This was given in 2008. John C. Williams. The modern approach to monetary policy stresses the importance of guiding and influencing the public's expectations about the future central bank's actions. In this forward-looking view of monetary policy, the current setting of policy interest rates, which is an overnight or very short-term rate, is on its own of little importance for the private agents. Right? Think about it. That is probably the most important thing to the mainstream media, but he is admitting that it's of little importance. Let me read it again. In this forward-looking view of monetary policy, the current setting of policy interest rates, which is an overnight or very short-term rate, is on its own of little importance for private agents. Decisions about consumption, investment, and labor supply and price setting. Instead, those decisions are more importantly driven by expectations of the future short rates. This was back in 2008 that they were discussing this. They were like, hey, we can talk about those interest rate adjustments and really gain true monetary policy. The interest rate adjustment, not so important. Not on its own, of little importance, really. This is what the voting members of the FOMC are saying. John Williams is probably one of the most influential people at the Federal Reserve. He's the New York Fed president. He's been there for a very long time. He has been in the strategy circles of developing monetary policy for, 20 plus years now. And to think about that, he was saying it almost 20 years ago now, that the adjustment of interest rates on its own of little importance. Instead, those decisions are more importantly driven by expectations of the future short rates. Right? I mean, here he is. He's straight up admitting it. There was a spot in here that I wanted to read to you again. Oh, here we go. It says this. Fed Research Director noted that an important rationale for releasing the directive stemmed, quote, from a desire at times to warn markets that a change might be forthcoming in order to reduce the odds of an overreaction because of the surprise when policy tightening or easing actually occurred. That was so good. Like, I don't know how many people heard that, but to me, that is as clear as day that they are gaslighting the people. They're gaslighting the markets. This forward guidance, it isn't just as simple as what people have to say. Oh yeah, forward guidance, we learned about that in Econ 101. It was just like, no, forward guidance and signaling and purposefully putting specific words and sentences into the message that is being delivered about interest rate adjustments that has an easing or tightening of financial conditions, that is not well known. Forward guidance is easy to understand. Oh, they plan on cutting at the next one. They plan on cutting every single time, or we're going to raise at every meeting a quarter point for the foreseeable future. These forward guidance messages are very well clearly communicated. The signaling is not. That you have to interpret for yourself. Okay? Let me read that again. Fed Research Director noted that an important rationale for releasing the directive stemmed from, this is talking about the communications of it, stemmed from a desire at times to warn markets that a change might be forthcoming in order to reduce the odds of an overreaction because of the surprise when policy tightening or easing actually occurred, end quote. Goes on, any such ability to shape markets' expectations of future policy by using policy statement would seem to be quite attractive. This is 2008, talking about how it is that they were going to use the market's expectations to guide monetary policy. Not the interest rate adjustments, that's not the important thing. The communication about it is. Right? Listen to some of these things. This is something I found very interesting when I read this section of it. The formulaic balance of risk language in the policy statement went as follows, with only one of three sets of alternative bracketed words to be used depending on the circumstances. So good. Tell me if you recognize some of this. Quote, against the background of its long-run goals of price stability and sustainable economic growth and of the information currently available, the committee believes that the risks are balanced with respect to prospects for both goals, weighted mainly toward conditions that may generate heightened inflation pressures, weighted mainly towards conditions that may generate economic weakness. These are the specific words and sentences that they communicate out there, right? This gets the market's reactions. They understand it. They've understood it since 2008, that they are going to be using their words more than their actions to guide the markets because their actions is no longer an effective tool. How many times have you heard Trump say, oh man, the Fed is doing wrong, they're doing political, they're doing all this other stuff because of their positioning on their interest rates? Of little importance, right? Of little importance. I mean, oops. Where was it? What did you say? In this forward-looking view of monetary policy, the current setting of policy interest rates, which is an overnight and very short-term rate, is on its own of little importance for the private agents' decisions about consumption, investment, labor supply, and price setting. Instead, those decisions are more importantly driven by expectations of the future short rates, especially as embodied in the long-term interest rates and other asset prices and going on. All right. Simon is so spot on with the Federal Reserve and politicians. One big show. They are just protecting asset values. Thank you very much, Jared. I really appreciate it, man. And thank you, everybody, for being in here. We got 158 people watching with 57 likes. I got about another 5 minutes left on my lunch break here, and then I got to go back to work. The part that breaks my brain is the people aren't getting raises. Well, people aren't, like, they're not going to. Right? The average day job is not, it's not there for them anymore. It's not there. I mean, there's a day job there, but it's not a day job that is going to be able to provide you with things that you need in your life, because that is a concept from time ago, right? In this cycle, we have moved beyond that. The average day job will never be enough. The wages increasing will never they just won't increase enough. Could they? Yeah, sure. You could give a hypothetical situation in which that they could do it, but they won't, because of the way that the new money comes into the system and separates the rich from the poor. The inequality will continue to grow. There is literally nothing that you can do to stop it, right? Understanding the situation so you can position yourself better for it, that's what you can do. But there's no politician, there's nobody coming, there's nobody showing up, there's nobody fixing it, right? That's not happening. All right. A raise isn't gotten, it's earned and fought for. Do you think there's a massive bubble coming? I mean, I would assume that, there's always a booms and busts. So yeah, I mean, there's like a massive bubble. I remember hearing about the everything bubble like 10 years ago, 15 years ago or something. They were like, oh, everything's out, everything's going to collapse, everything. And then, everybody was just like, well, I'm just going to wait and see. When that happens, then I'm going to load up on all the assets that everybody is, when they're crying in the streets because of the major bubble bursting that happens. And then the assets just kept going, right? Remember Donald Trump? It's a big, fat, ugly bubble. Well, yeah, that was his first administration, even before he was president. And what happened after that? It got bigger and fatter and even uglier. So, I mean, if he was talking about a big, fat, ugly bubble, well, I mean, 15 years ago, I don't even know how long ago it was now. I mean, it wasn't that long. But if he was talking about a big, fat, ugly bubble all those years ago, and if interest rates went up just a little bit, the whole thing was going to become crashing down. You remember him saying that? When Obama goes off to play golf and the interest rates go up, the whole thing is going to be crashing down. This is what Trump was warning everybody about, right? That the market was too big, it was a big, fat, ugly bubble, and it was about ready to pop. Well, from the time that he has said that, if it was a big, fat, ugly bubble then, what is it described as today? Like before, it was a little tiny, itty, cute little bubble. It wasn't a big, fat, ugly bubble back, like compared to what we got today. It was a cute little bubble. It wasn't a big, fat, ugly bubble. All right. All right. People live in political bubbles. They absolutely do, and that's an unfortunate circumstance for a lot of people out there because really the political awareness of people out there is so like, I don't know how to put it. It's like oversaturated, right? Like I don't know how, like, it's so many people have so many different opinions. There's so much, like, conflict that literally it's political fatigue. Like there's nothing that can happen at this point because of it. Like the politics are so angry in such a way that the people can never possibly form a good concept out of it because it's just this constant fight back and forth, right? So it's like political fatigue. Like normally you can get politics together and say, hey man, we'll have this discussion, we'll compromise on it, maybe we can come up with a good idea, but it doesn't, like, that's completely, trashed now. I wonder how much rental property in Somalia is worth. If you think logically about the economy, you will come up with a logical conclusion of where you need to put your money. Yeah, that's pretty true. I agree with that, deplorable. All right, the massive inequality between now and back in 2015 is incredible. I think we accelerated a lot. Yeah, it did. And M Rider 77, absolutely it did. I mean, during all the quantitative easing of the COVID era, right? That money, like a bunch of it went into into the hands of the household savings accounts. Like household savings went up and the inequality actually shrank. Well, I don't know if it necessarily shrank, but it stopped growing, right? It like kind of plateaued out. And then when the household savings depleted, it went right up to the rich and they just like launched themselves away from everybody else. So all the money printing, no matter what, will find its way into the hands of a few. I don't care if you give it to the poor first, they will deal with that money in a way in which that they will not keep it, and it will move and find its way into the hands of a concentrated few every time. No doubt about it. And people can argue all day long about all the things that could be done in order to prevent that from happening. There has never been a time in history that anybody can prove that being a real concept, right? Never in history have they ever had any kind of sustained economic or any kind of sustained economy by manipulating a situation in which that the rich didn't get richer and the poor didn't get poorer and the inequalities, maintained and all that. I mean, unless you're talking some sort of like communistic country in which that you don't own any of the manufacturers and everybody is basically a worker for the government and they went on for decades like that. I mean, if that's your example, good luck with that. Right? Good luck living in that sort of like that's not the environment that I want to be in. You know? Maybe somebody wants that in their life. I don't. I don't think that's a good way. All-nighter, the national median. Yeah, some cities have a 50% off sale for a while. Okay. me cruise it up here a little ways. Let me cruise back down. All right. All-nighter. Currency is a tool. Some can use this tool well and some cannot. It's really that simple. Absolutely, all-nighter. Absolutely. I mean, that's really what it comes down to. I mean, once you understand how money and currencies are different, right? And then you start looking at what it is that the United States had for money and what we are using for currency, and you can distinguish the difference between them all, things start to clear up, right? What we had back in the day with money was something that you could save. It would hold on to its purchasing power over time. What we have now is currency, and it's not really going to, we can wish and hope and dream that it will hold on to its purchasing power, but it really doesn't. It's meant to trade goods and services for other goods and services, and that's what it does. It carries those goods and services to another one. It's the currency of it. If you don't look at it for any other purpose than that, it totally works, right? You just use it to put yourself in a better position. You take your currency and you carry it over to some sort of asset that is going to have a return. Rental properties, dividend-paying stocks, bonds, something that you feel comfortable with. Right? But to expect it to hold on to any kind of purchasing power going into the future, it's very limited and not terribly wise, I guess. Okay. The supply chains are going to be fixed anytime soon. Are not going to be fixed or going to be? Because see, that's the thing. Like, I think about it myself. If the Federal Reserve is mandated to do two things, right? Low and stable prices with inflation around that 2%, I understand that that can be very subjective to what that really means. But then they also have this labor condition, right? Where they're supposed to keep unemployment low or full employment. Now, something that I had found very interesting through my studies is that the Federal Reserve and the money printer go burr and the low interest rates of the quantitative easing since 2008 all the way up until essentially the COVID pandemic failed to produce an inflationary scenario. So the Fed and the money printer and the low interest rates, it didn't do the inflation that a lot of people are blaming the Fed for today. Right? They said the money printer and the interest rates caused the inflation that we are experiencing today. And those same people who are saying that have no argument for why it didn't create the inflation back during quantitative easing 1, 2, 3, and 4. See, the quantitative easing of 1, 2, 3, and 4 was an expansion of the balance sheet that was way bigger on a percentage basis than what we had experienced through COVID. Like, they printed up more dollars during COVID, but on a percentage basis, they printed up far more during the Great Financial Crisis. They took the balance sheet of $850 billion to over $4.5 trillion. That was a huge expansion of the money supply and the balance sheet back in the Great Financial Crisis. And it failed. It failed to produce the inflationary scenario. So now people are saying, well, the Federal Reserve, they don't want to fire up inflation by bringing interest rates down. That might be a big concern of theirs. And I'm like, no, it's not. That is not true. Why would it be a concern of theirs? For 10 years after the Great Financial Crisis, they had zero interest rate policy, ultra low interest rate environment for a consistent amount of time, and it failed to produce an inflationary scenario. That doesn't make any sense to me. They are not worried about firing up inflation. What's causing inflation is a broken supply chain. If you disassemble the supply chain, you are going to create inflationary pressures. No doubt about it. If you alleviate that problem, it will bring the inflation down. This is one of the reasons why the Federal Reserve is saying, hey, this is going to be like temporary, the whole tariff thing. It's going to be a one-off. They're not going to really create an inflationary scenario because of it. Now, if that is the true case of it, then the Federal Reserve doesn't really have to worry about the inflationary part of it. That is really going to be coming from whether or not the tariffs are going to be persistent going into the future. That's where the inflationary scenario is found. It's found in that credible threat. Not inside of the Federal Reserve positioning the interest rates. If that was the case, then we would have found inflation back during the Great Financial Crisis. We didn't. So now when I think about it, the Federal Reserve can solve their inflationary problem, or not necessarily the Federal Reserve solve it. The Federal Reserve's inflationary problem could be solved with the alleviation of tariffs. That would then leave them in a position in which that they are only worried about the labor market. They're not worried about inflation. They want inflation. They like inflation. They want it elevated. Ben Bernanke had a huge speech talking about deflation and how to prevent it from ever occurring here. This is the results of what it is that the Federal Reserve was going to do once that problem was faced. Here it is. This is exactly what the Federal Reserve was planning from 20 plus years ago. I got to go back to work. Uneducated economist, you guys let me know.